accounting with an unguaranteed residual value. Adam Company, the leaser, enters into a lease with Davis Company to lease equipment to Davis beginning January 1st, 2019. The lease terms, provisions, and related events are as follows. The lease term is 5 years. The lease is non-cancelable and requires an annual rental receipt of $100,000 to be made in advance at the beginning of each year. The equipment costs $313,000. The equipment has an estimated life of 6 years, and at the end of the lease term has an unguaranteed residual value of $20,000 accruing to the benefit of Adam. Davis agrees to pay all executory costs directly to a third party. The interest rate implicit in the lease is 14%. The indirect costs are insignificant and assumed to be zero. And it's probable that Adam will collect the lease payments. So first, assuming that the lease is a sales type lease, from Adam's point of view, calculate the selling price. So we'll just do that here. We'll use the present value function, so we'll say equals PV, open parentheses, rate, they gave us a 14%, 5 years for the number of periods. The payment is $100,000. And then this is beginning of year, so we'll put comma, comma, type 1, close parentheses, and we get 391, 371, 23. I'm going to put a negative sign in front of this so that it reports it as a positive. And so we have that. Make that bold. Prepare a table summarizing the lease receipts and interest income earned by Adam. And so I just pulled down the summary of lease payments received and interest income. And so we'll start on January 1st with the balance of 371.23. And then on January 1st, there's also the payment of $100,000. And let me change all of these really quickly. And so we're going to say in cell F22 equals the previous balance minus the payment plus the interest income, and press enter. And even though there's no interest income here, I'm doing it that way so that we can pull this formula the whole way down. So we can do that now, and we'll see this same balance, but then as we add the interest income and the payments, it'll keep updating for us. So December 31st, 2019, we need to calculate the interest, and so that would be the previous receivable times the 14%, and then our January 1st, 2020, 100,000, and so we can just continue on with this pattern of multiplying the previous balances with the, not times 14, 14%, and then putting in our payments of $100,000. And we can see that that puts us to a zero balance at the end of the table, so that's a good sign. The third part is to prepare a table showing the accretion of the unguaranteed residual asset, and so this is that $20,000 accruing to the benefit of Adam. And so we have a table similar to our lease payments, but we're looking now at the schedule for the unguaranteed residual asset. And so we'll start out with the balance of the present value of that one lump sum payment. So we'll say equals PV, open parentheses, rate 14%, comma, number of periods 5, comma. In this case, it's a lump sum, so there is no payment, so we just put another comma. The future value is 20,000. And it's beginning of period, so we'll put comma 1, close parentheses, and we need to put a negative sign in front of our PV so that converts it to a positive number. And so then, December 31st, 2019, we can multiply our previous balance times our 14% and add those together. And we can just drag this formula the whole way down. And we see at the end, we come to the $20,000 ending balance. So again, that table confirms that we did things correctly, because if this wasn't $20,000, then we would be concerned that there was a mistake in the calculation. And then the fourth part, prepare journal entries for Adam, the leaser, for the years 2019 and 2020. So we'll have January 1st, 2019. And we'll start out with the lease receivable and sales revenue. For the 391, 371 that we calculated previously. Also, on the first, we need to account for the unguaranteed residual asset. So we'll have our unguaranteed residual asset, our cost of goods sold, as well as equipment leased to others. Oops. And so our unguaranteed residual assets, the $10,387 that we previously calculated. The equipment leased to others is going to be this $313 from the previous information that we have. And so that gives us the difference of $302,612 for our cost of goods sold. Then finally on the first, we're going to have a debit to cash, maybe, and a credit to lease receivable for that first payment of $100,000. When I say payment, I mean the payment from the other company to us, so it's really a receipt. All right, so then in 2019, on December 31st, we're going to account for the interest that we've earned, this $40,791, and so we'll have lease receivable and interest income. We'll just cell reference that 40,000. And then we also need to account for this interest income from the unguaranteed residual asset. And so we'll type 31 here, and the debit will be to the unguaranteed residual asset, credit to interest income, and we'll cell reference the 1454. And so that concludes it for 2019. Then for 2020, on January 1, we're again receiving this cash payment, so we can just copy this down. And then on December 31st, we're going to have the same lease receivable and the unguaranteed residual asset, both of these transactions. However, we have to reference the updated numbers for the new year from our table. So we'll come up here and reference the $32,502. And for the unguaranteed residual asset, we'll reference the $1,657. And that concludes this problem.